Money within the economy can take several forms. Cash, notes and coins, accounts for only 3% of the money in circulation, whilst the remaining 97% of the money in circulation within the United Kingdom economy comprises credit money that has been created by banks. Central bank reserves refer to commercial bank reserves that are held at the central bank, which are presented in the central bank's electronic record of the amount owed by the central bank to each commercial bank to facilitate large-scale payments between commercial banks. Stay until the end of the video to find out banking, how credit and money work. Banking is a highly regulated industry. The Federal Reserve System oversees banks and other financial institutions and coordinates with state regulatory agencies to help ensure banks follow the proper guidelines. Banks are also subject to regulation by other federal agencies, including the Office of the Comptroller of the Currency, the Office of Thrift Supervision, and the Federal Deposit Insurance Corporation. Banks, whether brick-and-mortar institutions or online, manage the flow of money between people and businesses. More specifically, banks offer deposit accounts that are secure places for people to keep their money. Banks use the money in deposit accounts to make loans to other people or businesses. In return, the bank receives interest payments on those loans from borrowers. Part of that interest is then returned to the original deposit account holder in the form of interest, generally on a savings account, money market account, or CD account. Banks primarily make money from the interest on loans and the fees they charge their customers. They also run call centers with extended customer service hours. How do they pay for all of those services? Banks earn revenue from investments or borrowing and lending, account fees, and additional financial services. Whenever you give money to a financial institution, it's essential to understand its business model and exactly how much they charge. But it's not always clear how banks get paid. There are several ways for banks to earn revenue, including investing customers' money and charging fees. A bank's ability to create new money, which is referred to as credit money, is a consequence of a range of factors. Firstly, non-cash transactions account for more than 95% of all transactions conducted within the economy, with non-cash transactions being settled through non-cash transfers within the banking system. Banks act as the accountant of record within the financial system, which enables banks to create the fiction that the borrower deposited money at the bank. Members of the public are unable to distinguish between money that a bank has created and money saved at the bank by depositors. Banks' ability to create credit money is also a consequence of being exempt from the client money rules. Before continuing the video, be sure to smash the like button and subscribe to never miss out on any of our videos. For example, a bank pays a 1% annual percentage yield on cash and savings accounts. Customers who get auto loans to buy new cars pay 6.27% APR on average. That means the bank earns theoretically 5.27% on those funds, but potentially relatively less if you account for operating expenses. It will earn even more with credit cards. According to the Federal Reserve, the average annual percentage rate on credit cards is 16.3% as of October 2021, the most recent data. The accounting entries associated with the second stage of the process, when the bank places money into a borrower's bank account, is the point at which the bank's accounting treatment of the loan differs from other types of financial intermediaries. A bank creates new credit money as a consequence of its accounting treatment of liabilities. This accounting process causes the bank to create a new customer deposit that was not previously paid into the bank, but instead represented the reclassification of an account payable liability of the bank. This accounting treatment of the transaction enables the bank to expand both sides of its balance sheet at the same time when making a loan. The banks must continually consider the risks associated with their lending. The risk categories are liquidity risk and credit risk. Liquidity risk reflects the bank's maturity transformation. While most deposits can be withdrawn or moved to another bank at short notice at the customer's request, loans usually have longer maturities. Access to stable funding is important to a bank. Funding sources include deposits from households and firms, including fixed-term deposits. Such deposits cost more to attract than demand deposits, since the depositors demand compensation for binding their money for a certain period. Banks may also resort to money and capital markets, but these funding sources are often regarded as less stable than deposits. Credit risk reflects the experience that some borrowers default on their loans. During the financial crisis, the banks that became subject to resolution were to a high degree those banks that had experienced strong lending growth in the preceding years. When a bank considers return against risk, it does not necessarily take into account the social costs of its potential failure, such as financial instability and lower economic growth. Since the bank's liabilities do not extend beyond their equity capital, they may have an incentive to assume greater risks, on lending, than what is desirable for the economy overall. When choosing a bank, it's important to do your research. Start by looking at the types of products and services offered. Ideally, you want to find a bank that offers the accounts or services you need, whether a checking account, savings account, or loan. You can also look at whether a bank offers interest on checking balances, though this is less common. You may avoid many of these fees by choosing an online bank over a traditional bank. Finally, look at the convenience and service a bank offers. If you're choosing a brick-and-mortar bank, how many branches does it have? Are they easily accessible to where you live and work? And does the bank offer a user-friendly online and mobile banking experience? With an online bank, consider whether it has a robust mobile app. Can you access your accounts at an ATM? And if so, will you pay a fee? Asking these kinds of questions can help you narrow down the list of banks. As a consumer, you're probably familiar with bank fees that hit your checking, savings, and other accounts. Those charges are getting easier to dodge, but fees still make a significant contribution to a bank's earnings. For example, Bank of America's Advantage Plus checking account charges a $12 monthly maintenance fee. Over the course of a year, those fees will cost you $144. However, you may be able to waive monthly maintenance fees by maintaining a certain balance or setting up direct deposit. Banks also charge fees for certain types of actions and mistakes you make in your account. If you enrolled in overdraft protection, it'll cost you $30 or so every time you overdraw your account. A bank must also ensure that it has sufficient provisions and capital to cover unanticipated losses arising from bad and doubtful debts, whilst also meeting regulatory requirements. The creation of credit money is determined by a commercial bank's confidence that issued loans will be repaid. Therefore, banks' perception of credit default risk is an important factor influencing the amount of bank lending. Strong growth in property prices over a prolonged period of time reduces the bank's perception of the level of credit default risk associated with property lending, because money owed as a consequence of the borrower's failure to repay a loan will be recovered by the bank repossessing the property that provided security for the loan. Secondly, borrowers are likely to repay loans whilst the asset value exceeds the total amount of money outstanding on the loan. When property prices are continuously increasing, the bank will perceive that property lending incurs a very low credit default risk and will therefore attribute a very low level of credit default risk when lending for property purchase. Levels of credit default and bank provisions for bad and doubtful debts are likely to increase substantially in the event of a significant reduction in property prices. Banks print cashier's checks for significant transactions, and many also offer money orders for smaller items. In addition to standard bank accounts, some institutions offer products and services through financial advisors. Commissions and fees, including assets under management fees from those activities, supplement bank profits. Banks often handle payments for large and small businesses that want to accept credit cards and ACH payments from customers. Monthly and per-transaction fees are common. If you worry about thieves printing fake checks with your business account information, you can have the bank monitor all outgoing payments before they're authorized. But of course, there's a fee for that. Depending on your bank and the type of loan, you might pay an application fee, an origination fee of 1% or so, discount points, or other fees to get a mortgage. Those fees are in addition to the interest you pay on your loan balance.